Okay, so while we were away over the last fortnight or so, Gamma Communications, which I mentioned about 3 or 4 weeks ago now for the first time on this show, came out with one of its nice updates. And when these things happen, every company, when they're updating on their update day, releases their report at 7 in the morning in the UK. They all come out together, and the market opens an hour later. And when there's one that I'm interested in, I sometimes have a look at it and say to Steve, looks good from Judges Scientific, or looks terrible from Greg's, or have a guess at which way the stock is going. I mean, it's no time to do anything in that hour or so because the UK doesn't have a pre-market or whatever, but it's fun to have a bit of a guess and just see whether I'm in tune with the market or have a different view. And recently, I've been getting a better sense for how I think the market goes on these things. Well, Gamma Communications is one I would have got, I don't know, probably right and wrong at the same time, I guess, because after this thing's earnings, the stock, by the way, is currently down 36% since the start of the year, and over the last fortnight, it's down about 6%. So, bit to see there, but not a huge amount, you might think. You would be very wrong. So immediately after this thing's earnings, the stock went up 11%, which is quite the jump. And I was saying about a month ago now, I sort of quite like the look of this at these prices, and 11% higher, I thought I've missed my opportunity. And it's easy to see why it went up 11%, because they reported revenue growth. This is a growth company, but I'm not going to talk about their balance sheet, of 12%, which is pretty strong, takes them up to 317 million, an adjusted EPS of 47.9p, which is up 13%. Those are some decent numbers. Very nice. And literally minutes later, the thing came crashing back down again 14%, undoing all of its previous rise and a bit more as well. What exactly happened in that kind of, quarter of an hour, maybe even window there, when there was no kind of big macro thing that suddenly meant bad news for Gamma? There was nothing particularly in terms of the business that changed. There was no update that came out after that one. And I think the reason was investors just misread this report, or at least just looked at the headline numbers for this report. And I sort of get it in some ways. Back to my point about predicting stock directions here, I certainly wouldn't have said up 11% followed by down 14% in the space of the first 15 minutes or so. So I wish I had. I'd have retired by now if I'd successfully called that correctly and gone short when thing was up 11%. But here's the problem for Gamma, or here's why their report, people suddenly changed their mind about this report. As you read further down, and in fairness to Gamma, not a lot further down, only past the kind of top table of results or so here, it transpires that 12% revenue growth was almost entirely driven by acquisitions. And there's nothing wrong with being driven by acquisitions. Plenty of good companies that we quite like rely quite heavily on acquisitions, but you can only acquire a business once. So that 12% revenue growth, and Gamma is not a serial acquirer like a sort of Diploma or a Judges Scientific or a Halma or something. They've done a set of one-off acquisitions, and that's driven their revenues higher by, quite a bit. Without that, their revenue growth was going to be a mighty 1%, which is fairly different to sort of 12%. 1% versus 12 is okay. Yeah, that's not encouraging. And that was entirely driven by Germany, by the way, with nothing from the UK. Germany-wise, so you're looking for organic growth as in some cases where the company isn't a major acquiring company. There's a couple of things about acquisitions, I guess. One is that they're widely seen as risky, and I think that depends a lot on the kind of acquisition that's being done. Some of them definitely are, and some of them you probably shouldn't think are as risky as others. But in the case of something like Gamma, where acquisitions are, yes, part of the strategy, but very much one-off things at any given moment, you should probably think that the organic growth or otherwise gives you a better sign of what the long-term picture is going to be like, at least for the moment. And 1% is very different to 12%, and that's why the thing came cratering back down again. The fact that Gamma didn't put this on the kind of front page of their earnings thing, I thought is... I'm in two minds about what to think about this. It's a relatively new addition to the FTSE 250, by the way. It was off the main market. I think it was on the AIM until maybe even earlier this year, actually. So it's not been there for long. But if you look at the reports for something like a Diploma, the first thing you see is revenue growth, and the thing you see underneath that, revenues, the thing you see underneath that is organic revenue growth, because they will want to split out and tell you very clearly how much of this is organic, even if the number is bad, and how much is acquisition driven. And I think the reason is investors treat those very differently, rightly or wrongly here. Gamma, like I say, doesn't do acquisitions kind of on the regular, like a bundle or diploma or whatever. So they don't normally split out organic growth like this as a matter of routine, and they're not necessarily required to. And they do kind of say it in the comments, though I thought that the CEO is kind of a little bit coy in the way that he talks about these things. He talks about organic revenue growth being boosted by acquisitions or bolstered by acquisitions. And I sort of think, the organic growth is being bolstered by acquisitions in the same way that Amazon stock is going up because I'm buying it, being boosted by everybody else in the world, or something like that. Clearly, the majority of the work is not being done by me, but am I part of that story? Yes, sure I am. Would the amount it went up be less if I'd gone away? Well, maybe strictly, but some vanishingly small amount that nobody cares about. So it's, I think, tricky to work out what to think of this one. I kind of view the report as sort of rubbish in terms of revenue growth of 1%, earnings per share growth of 3%. It trades at an adjusted PE of now just under 11. And the adjustments, I think, are not crazy despite the slightly weird reporting style here that I think genuinely took the stock market in for about 10 to 15 minutes or so there. They're putting it down to a difficult trading environment in the UK, and I believe them when they say this. They're talking about businesses being cautious. The big catalyst that Gamma has coming its way is that 31st of January 2027, BT, I think, is set to retire all of its kind of copper network. So all of your kind of phone-based copper communications are going to have to go cloud from some business, and Gamma is in a strong position to sweep up what should be some kind of, as it were, people who have to convert by that point, or basically not use phones in the same way anymore, and that should be a good thing. But as I saw it in terms of this particular update, this was not good, and it was certainly not as good as people initially thought it was, Steve. The only question is whether this is an overcorrection in a difficult environment. Maybe is my answer there, but I enjoyed watching this very much.
Yeah, stock's down quite a bit year to date now, Steve. It's just added to that fall, so it's down like over a third now by the looks of it. So that's not particularly good. But yes, I can see the report is fairly kind of confusing if you're skim reading it. I think it's it takes a second read just to spot how kind of bad it is in places, because 1% is way below inflation, so, and way below all the sort of cost input that's been going in. So you would have hoped that they would have pushed the price of their product up to try and counter the additional sort of input costs from just running a business and having staff, but it doesn't appear like they've been able to do that. But you also know a company is in serious trouble when on the seventh word they start talking about acquisitions, and then the second paragraph is a whole, it's been donated to how they're in a position to make acquisitions. It's kind of like, we don't actually know how to grow, so what we're going to try and do is sellotape on about 15 businesses and try and sort of paper over the cracks while we figure it out. So yeah, that's not the best thing I've seen, but it's come down a bit in price now, Steve. So does it go back on the watch? Is there something to buy, or is this? Because look, I think you're saying, look, it's only 11 times earnings, but for me, if something isn't growing, 11 times earnings is really bloody expensive. So I would be sort of worried about doing that. I think the other side of it is everything that they bolt on is going to be likely done out of their own cash. It's not going to be done out of debt or dilution, you would hope. So there is that, and then obviously you have got this kind of positive, tailwind ahead that you describe with the copper networks being retired. So it might be a little bit of short-term pain, long-term gain kind of thing, Steve. So is this something you're going to buy and sit on, and that's your thesis?
There's a bit of that about this, isn't there? Of clearly it's they want to tell you that this is going through a short-term difficulty, which is to say a tough business environment in the UK, blah, 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 worries about government taxation, budget, etc., etc. how seriously you take that, up to you. But that's what they want you to think here. And they're kind of priced like they're in a difficult trading environment. They're priced like that trading environment, I think, is going to hang around here a bit. As you point out, if your growth is only going to be acquisitions here, and Gamma doesn't really have. If you want an acquisitions only company, I don't think Gamma is the strategy for. If you think, as we do, I think in some cases, actually, it's a perfectly good business model to go around rolling up smaller versions of your thing. And either running them better or providing them with better capital or doing things for them that they can't do by themselves. That's a legitimately good business model if you can do it well enough. But Gamma isn't really the type to do that sort of thing, or it doesn't have the track record of other things in this kind of way. I think they're an odd kind of organization. I think I'm getting there with them, and I'm minded towards seeing kind of what happens over the next year or so. I mean, 1% revenue growth and 3% EPS growth makes me very wary about trusting their adjusted numbers. I mean, you want to take out certain things like one-off costs and so on to give you an idea of how business is going on balance, but the growth, even in adjusted terms, isn't terrific. Sorry, on an organic basis, isn't great even in adjusted terms here. So I think it's a hard one. I mean, if I don't mind the idea of buying this with a view to sitting tight until for about 2 years, say, and seeing what happens. The trouble is, for 15 months or so, it's going to be indistinguishable from whether you're right or whether you're wrong, I think, in this case. If you think, look, something big for us is coming at the start of 2027, it's hard to see what you want. It's hard to know what you want to see to mean your thesis is on track between now and then. Because on the one hand, if you're right and things are all going to switch over when January comes around and people will scramble to sign up to your platform, what you expect to see is nothing and then everything. And if you're wrong and they're going to do something else, what you expect to see is nothing and then nothing. And both of those start with nothing. And Gamma has the feel of the kind of, I want to say, value trap a little bit that I said to myself at the start of the year I was going to try and avoid, which is say, this is cheap. Over time, it will go up. But if I have to sit around for so long that my eventual gain isn't worth it, then I have a basic problem in this case, right? If I think I'm going to get something that's going to go up 15% and it's going to do that in 3 years' time, that's not a good result. You bought something that was undervalued, correct, it got back to where it was meant to be, but it took so long to do that you've been better off with the index. Simple as. I don't know whether I'm there on Gamma yet, but I intend to give this one a bit more thought and see how we go. I have other more obvious things to consider buying, but we'll get onto those in a little bit, Steve. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.